Now we come to the Unit 3, investment in associates. So basically, for investment in associate, we'll use the equity method. So in summary, what is equity method? Equity method simply means on initial recognitions, everything will be stated at cost. So the investment in associate will be stated at cost. Cost is the consideration that we pay, the fair value of the consideration that we pay at the day of acquisition of this investment in associate. So that means we will debit investment in associate and credit cash. Of course, we use equity method also for joint venture. So therefore, if this is a joint venture, we call it debit investment in joint venture and credit cash. After initial recognitions, we will share everything of this investment associate. Therefore, if this investment associate have got profit, we will debit investment associate and credit profit from associate. If we receive some dividend from this associate, we will debit cash or we debit dividend, and then we credit investment in associate. This is equity method. So we must use equity methods to account for investment in associate and joint venture. So strictly speaking, if we don't have a subsidiary, we don't prepare consolidated financial statements. Still, we need to account for this investment associate using equity method. Therefore, if in your own financial statements, you simply use fair value through profit and loss or cost or fair value through other comprehensive income to account for this investment associate, now you need to prepare another set of financial statements using equity method. Of course, if we are going to prepare consolidated financial statements, then in the consolidated financial statements, you will use equity method, and then in the separate financial statements that the parent will prepare, they will use cost or fair value through profit and loss or fair value for other comprehensive income. Just like the consolidation, there will be exception. So if this is an investment entity, we don't ask you to use equity method. We simply ask you to account for your investment using fair value for profit and loss, just like the subsidiary. And also there will be an exemption. So if you fulfill all the 4 criteria, just like what a subsidiary has done, then you can be exempted from preparing the equity method for your investment associate, just like the intermediate parent, that they don't need to prepare consolidated financial statements if they fulfill all these 4 criteria. So as I've said before, what is equity method? Equity method simply means the investment is initially recognized at cost, and then we adjust thereafter after the day of acquisition of this investment for any share of the net assets of the investee. So therefore, if this investee, if this associate have got profit, we share the profit, we debit investment associate and credit share of profit. But not only we share the profit, they can have any increase in other comprehensive income like revaluation reserve, translation reserve, other reserve, etc. So for any increase in reserve, we share as well. So basically, we share any increase in profit and reserves. You understand that? Increase in net asset means increase in equity in terms of the figures. Therefore, actually, whenever the equity of that investment associate increase because of the increase of profit, reserve, revaluation reserve, etc., we share. Therefore, basically, we share everything. Increase in net asset, that means increase in equity in terms of the figure. This is the reason why we call it equity method, because whenever the equity of the associate increase, our investment balance increase. Why? Because we share the profit, we share the other comprehensive income. So we initially recognize it at cost. Just like any investment value, it consists of 3 components. The first component is the share of the book value. Second component is the share of the fair value adjustments. and the third component is share of the goodwill. So we have got the share of the book value, share of the fair value adjustments, and the goodwill. Just like the non-controlling interest, we'll have all these three components, right? Because non-controlling interest, they are investors. Investment in associate, we are investors. Any investments consists of these three components: share of book value of the net asset, share of the fair value adjustments, and the goodwill component. But for investment associate, because this investment already include these three components, therefore actually the goodwill, when we acquire this investment associate, has been included in our investment value. We include our investment in associate at cost. Therefore, we say that goodwill is implicit in the cost of investment. In other words, you will not find any goodwill amount in your investment. If this is an investment associate, there's no separate accounting for the goodwill, unlike the subsidiary. Of course, we understand, because we have goodwill only if there is a business combination. Purchase of investment associate is not a business combination. Parent acquire a subsidiary is regarded as a business combination, but acquisition of associate is not. Associate is not part of the group. A group includes only parent and subsidiary. Therefore, there will not be any goodwill account that you will find if this is just an investment associate. So after we share the investment at cost, we have to share all the post-acquisition change in net asset. So as I've said before, whenever this associate have got any increase in net asset, so why net asset will increase? Probably because they got profit, so we share the profit of that company. Not only the net assets will increase, right? So assets value increase because of the profit, of course, but assets value increase also because of the revaluations, etc., etc. Therefore, we share also all the other comprehensive income after the date of acquisitions. So we share all the revaluation reserve, transaction reserve, other reserve, general reserve, etc. if they increase after the date of acquisition. Because there may be a fair value adjustment, higher fair value will attract higher depreciation. Therefore, we may have to adjust for any further additional amortization and depreciation because of the fair value adjustments. And also there may be intercompany transaction, and therefore we may have to adjust for any unrealized profit arising from the intercompany transaction between the parent and the associate, or between the subsidiary and the associate, or even between one associate and another associate. Dividend should not be recognized as profit. In the parent's own book, they have recorded dividend income, and therefore now we may have to eliminate some of this dividend income. So this is what we will find for investment associate. So in the balance sheet, in the consolidated statement of financial position, investment in associate will be treated as a single item under non-current asset. It is a non-current asset. But on the face of the consolidated statement of comprehensive income, we will separate the amount of the associate into two portions. One is the share of profit of associate. We will insert the share of profit of associate as the last line item before we total for the profit before tax. So this will be the last item. Actually, all equity accounting investments we will include under the last item. So therefore, you may have a share of profit of associate, you may have a share of profit of joint venture, or sometimes we group them together, share of profit of associates and joint venture here, or as the last item. Not only we share the profits, as I've said before, we share the other comprehensive income. So therefore, just before we total for the total comprehensive income, we may have a share of other comprehensive income of the associate. Let's see a simple example. Here, S acquired 20% of associates. we call it an associate because we got 20%. If you have got 20% significant influence, I don't argue with you. This is an associate. When did we purchase it? We purchased it on 1st of January 2004. On that day, the cost of acquisition was 6 million. Therefore, on the day of acquisition of this associate, you must have debited the investment associate and credited cash 6 million. Now, it is already 31st of December 2005. We need to prepare the equity accounting entry on 31st of December 2005. So 2 years has passed. 1 year is 2004. Now it is 2005. Anyway, the retained earning at the acquisition day was 15 million. At the beginning of the current year, it increased to 20 million. Therefore, we will share this increase in retained earnings. At the day of acquisitions, it was 15 million. It increased to 20 million at the beginning of the current year. So the retained earnings increased by 5 million. As a 20% associate, we can share 20%. Therefore, we debit investment associate 1 million and we credit retained earnings 1 million. Increase in retained earnings. As I've said before, profit or therefore the retained earnings is just one example. If you find any increase in revaluation reserve, increase in other reserve, you will debit investment associate and credit revaluation reserve or share of revaluation reserve and credit share of the other reserves. Not only we share the retained earnings and the reserves in the balance sheet, we share also the current year profit. But before we share the profit, we notice that actually this company have got an excess of fair value over the book value. At the day of acquisition, this fair value adjustment was 5 million. This 5 million should be depreciated over the remaining useful life, which is 10 years. So therefore, every year we have to adjust. How much? If this is a subsidiary, it will be 5 million over 10 years. But this is not a subsidiary. So therefore, we share only our 20% after tax. Right? We always share everything after tax for an associate. So therefore, every year we have to adjust for 80,000. If this is a subsidiary, you will debit depreciation and credit accumulated depreciation because higher fair value, higher depreciation. So for a subsidiary, you will debit depreciation and credit accumulated depreciation. This is not a subsidiary. We don't consolidate associate. So for anything which is related to a profit and loss item, we simply debit share of profit of associate. For any item which affects the balance sheet, like here the accumulated depreciation, we don't really credit accumulated depreciations, we credit investment associate. So for the profit and loss item, we debit share of profits of associate. For the balance sheet item, we credit share investment in associate. This represents 2 years accumulated depreciation. So we debit share of profit of associate for the current year, and we debit retained earnings for last year. This represents 2 years additional depreciation. Now we can really share the current year profit. The question says that the current year profit before tax was 10 million. There will be a taxation of 2.1 million. So therefore the profit after tax 7.9 million. Profit after tax 7.9 million. As a 20% associate, we share 20%. Therefore we debit investment associate 1.58 million and we credit share of profit of associate 1.58 million. After all these adjustments, we can see that initially we have recognized this investment at cost, which was 6 million. We share the post-acquisition increase in net asset. This includes the retained earnings in journal number 1. We have to adjust for the fair value adjustments, higher fair value, higher depreciation. So therefore in journal number 2, we reduce the profit, we reduce the investment by 160,000. And then in journal number 3, we share the current year profit after tax. So the investment in associate under equity method as at 31st of December 2005 should be 8.42 million.